The housing market is shifting, and it is shifting fast. If you've been watching the headlines lately, you're probably wondering what these latest numbers actually mean for your wallet, whether you're out there buying or you already own a place. Well, we're going to transform those massive national statistics into clear, actionable insights. Let's break down exactly what the May 2026 housing data is telling us.
Okay, let's dive into this. Here is our roadmap for today's explainer. First up, the 2026 housing market snapshot. Second, decoding the Affordability Index. Third, the hidden costs of homeownership. And finally, protecting your biggest investment.
Kicking things off with Section 1, the 2026 housing market snapshot.
Just take a second to look at the sheer scale of this number. $429,300. That is the new record-high median sales price for existing homes as of May 2026. A fundamental ongoing lack of supply out there just continues to push prices upward for prospective buyers all across the nation.
Now, counterintuitively, you might think these record-high prices would just completely freeze the market, right? But nope. Existing home sales actually jumped 3.2% in May, hitting a 4.17 million annual rate. That is literally the highest momentum we've seen since December. So despite the really high barrier to entry, a significant number of people are for sure still out there, actively closing deals.
So, to make sense of this dynamic, Dr. Lawrence Yun, chief economist at the National Association of Realtors, notes that more Americans are on the move. And he specifically points to improving affordability as a key driver. Wait, how can affordability be improving if prices are sitting at a record high? Well, it basically comes down to one critical factor: income gains. Income gains are actually outpacing home price growth. So even though house prices are climbing, wages in most parts of the country are climbing just a little bit faster.
Move in right along to Section 2, decoding the Affordability Index. To measure all of this objectively, we rely on the Fred Housing Affordability Index. Just as a quick refresher for us, a baseline value of exactly 100 means the median earner has precisely enough income to qualify for a medium-priced home, assuming your standard 20% down payment. It's kind of like the perfect equilibrium point between wages and housing costs.
Simply put, anything below 100 means you fall short. Above 100 means the median family has more than enough income to qualify. As a buyer, you absolutely always want to see this index sitting comfortably in the green to signify true market affordability. So, for May 2026, the FIX index came in at 105.6. Now, context is really key here. Back in January, it was higher, sitting at 116.5. Affordability has dropped as prices hit those new highs we just discussed. But crucially, remaining at 105.6 proves mathematically that the median income is still hovering above the qualifying threshold for the median home.
Okay, so getting that mortgage approved is a huge milestone, driven by all those macroeconomic factors we just looked at. But I want you to think about this question for a second. What happens after you get the keys? Because let's be real, the financial journey doesn't just magically end at the closing table. In a lot of ways, it's just beginning. We're shifting gears now from the national data to the day-to-day reality of actually owning a home.
Which brings us to Section 3, the hidden costs of homeownership.
The Canada Mortgage and Housing Corporation, or CMHC, warns that projecting a budget based only on your mortgage and taxes is a total trap. You really have to factor in the less glamorous realities of homeownership, things like snow removal, paying for security systems, gardening, and condo fees. And of course, the unexpected repairs. Honestly, nothing humbles a new homeowner quite like a sudden $1,000 water heater replacement.
And finally, Section 4, protecting your biggest investment.
The CMHC outlines a genuinely solid defense strategy for your finances. Step 1, set up auto payments synced exactly with your payday so you never accidentally spend your housing budget. Step 2, keep 3 months of mortgage payments sitting safely in savings. And Step 3, if trouble hits, communicate. Missing payments totally damages your credit, but lenders can very often help you out if you call them early enough.
But wait, what about those hidden operating and repair costs we just talked about? Well, for that, the CMHC has a golden rule: 5%. Save 5% of your take-home pay and put it straight into a dedicated account. Let's be clear here, this is completely separate from your standard savings. This is your specific emergency fund to deal with an unexpected roof leak or a broken furnace without completely derailing your life.
At the end of the day, protecting your investment requires vigilance. Prepare a monthly budget and review it honestly.
Take control of the math by using tools like an affordability calculator to stress test your finances. And hey, if the numbers start working against you, don't wait around. Seek out a professional advisor who can help guide you back on track.
Wow, we've covered a massive amount of ground today in this explainer, from record-breaking $429,300 national home prices right down to the snow removal costs in your very own driveway. The data shows that while prices are definitely high, incomes are actually keeping the dream of homeownership alive for many. But as you process all this, I want to leave you with one final thought. With the market moving the way it is and those hidden costs continually adding up, is your emergency fund truly ready for the unexpected? Thanks so much for joining me to demystify the data today. Keep preparing, and I'll catch you in the next explainer.